Okay, good evening, everyone. So, let me introduce Mr. Rajeev Agrawal, who is our guest faculty. Now, Mr. Agrawal is the founder, fund manager, and managing partner at DoorDarshi India Fund. It's a US-based fund, and it is registered as an FAI, Foreign Portfolio Investors in India. Now, he has been investing in Indian stock market since 2014, and he is also a top ranked analyst as per Sumarja out of 15,000 plus analysts. Yeah, please. Now, prior to starting DoorDarshi, Rajiv worked as a managing director at S&P Global. And prior to that S&P Global, Rajiv worked in a senior role with different banks, that is Goldman Sachs, then Bank of America, JP Morgan Chase, Dresdner Bank, etc., etc. And about his educational qualification, he has done MBA from IIM Calcutta. He passed out in 1998. He is the batch of 1996-98. And prior to that, he did his BTech from IIT Bombay. That is 1995 to 1991 to 1995. He has also done CFA course from CFA Institute, USA. Now, he had been working in US, particularly in New York, for many years. And for many years, he has walking down along the Wall Street. I don't know how many of you have visited Wall Street, but but he has been there for many years. Yeah. So I hope that he is from the industry. He used to work earlier with the different banks as at a very high position. Now he has started his own fund. So whatever practical experience he has gathered, so I would like to request Mr. Agrawal to share his experience with this class. So hope all of you enjoy the class. Okay, Mr. Agrawal, you may start, please.
Thank you, Professor Karmakar. Am I audible to everybody?
Yeah, you are audible.
Perfect. So let me share my screen and hopefully we can get started. Okay, so hopefully the presentation is visible to everybody. So thanks to Professor Karmakar for inviting me to give a lecture to IIM Lucknow MBA class. I think every year I take this class and it's something that I look forward to every year. So it is wonderful to be talking to some of the brightest minds in India on how we invest and our practitioners' view on investing. Before I start my presentation, a few quick things. I will talk about my performance here, but this is not to be construed as us trying to sell anything. Everything that I'm sharing is confidential, so you should not transmit or reproduce without taking our consent from the firm, which is DoorDarshi Advisors. There are a lot of forward-looking statements, and don't put undue reliance on that. And lastly, whatever I'm sharing is for information, for knowledge purposes. I'm not looking to sell anything, not trying to for you to buy into the fund, but really sharing how the fund has done, what is our approach. And so it's more of information sharing rather than anything that we are trying to sell to you. So with that, this is the agenda. I will spend, Professor Karmakar gave some details about myself. I will talk a little bit about myself once again, as well as about the fund. So you have some background of what I have done and what I currently do, which is the fund. Then really we want to jump into the investing world. And I first want to ensure that everybody is aware of when I talk about investing, what is it that I am referring to. So we'll go through the basics. And these basics are helpful in ensuring that the terminology that you are having in your mind and the terminology that I am using, at least we are on the same page. Then what I will do is I will spend some time talking about our investment approach, what we do at DoorDarshi India Fund. And how this approach has helped us in delivering good returns in the past. So I will tell you a little bit about our returns and what we think has helped us in delivering good returns. Then we will spend some time talking about, when the markets are good, that's great. But when the markets are not so good, which is much more important and interesting, how one should behave during those uncertain markets. Depending on how much time we have, I also have some information because many times, obviously, I am sitting in the US investing in India. And one of the questions I get is US markets are doing so well. Why don't you invest in the US market? So I will give you some perspective on what is our case for why we invest in India and Indian equities and what we think will be the impact of tariffs that currently are in the works, how the US tariffs may have an impact on Indian equities. I'm sure some of you follow Indian equities quite closely. And so I think it will be good to get your feedback as well. And then, depending on how much time we have, we can then go into the case studies. And these case studies are things that I've already published in on SumZero that Professor was referring to earlier. And so we can spend some time talking about these case studies, which will bring everything that I will talk about to a more practical manner. Now, one thing that I would say is that let's call it, because this is a 3-hour session, and I'm assuming that we will break around 1:30, 1 hour in 1 hour 30 minutes. So, but what I will do is every around 30 minutes, I will give a break and I will let you ask any questions that you have. The one thing I will also tell you is that I cannot hear the class. So if you are going to have to ask a question, I think you need to get the microphone so that from that microphone, the one that Professor Karmakar was using, you use that microphone to ask the question. And that way I can hear you. So it is, and it will be a lot more fun for me if you participate through your questions or comments as we go through the class, because I think I always feel that when the class is participating, when you're asking questions, I get a little bit better sense of whether the class is able to go along with me or there are some big questions, doubts that we should address first. So the more questions you have, I think the more the fun the class will be. And I frankly think you will learn more out of it. In addition, if you have some ongoing questions, it will be so much more interesting if you bring those questions. I'm not saying I will have all the answers, but to the extent that I can try to answer the question in a manner that I understand, I'm very happy to do that. So that is what we will do in terms of how we'll go about it. So every 30 minutes or so. So right now we are around, at my time, 10:30, right? So around 11, I will pause. And if you have questions as I present, just keep writing it down. And then we will give a few minutes, every 30 minutes for you to ask questions. Okay, so moving on. So a little bit about myself. So as Professor Karmakar said, I am a fund manager as well as a founder and managing partner of this fund, which is DoorDarshi India Fund. A little bit about my investment journey. So I started investing in Indian equities actually have been investing for more than 20 years. I became a full-time investor in 2016. And that is when I moved out of my corporate world to focus only on investing. In 2021, I launched DoorDarshi India Fund. And so this is a US domiciled hedge fund which invests in Indian equities. And the whole idea here is to bring the opportunity that India is to the international investor base. Apart from that, as Professor Karmakar mentioned, I am a top-ranked analyst on this website called SumZero. SumZero is a platform where individuals can submit their research ideas. There are more than 15,000 analysts on that platform. And I'm ranked number 1 in East and South Asia, which basically means East and South Asia also has India. Most of all my ideas that I have submitted are ideas in the Indian stock market. And we only invest in the listed equities, so everything is listed. And so from that perspective, I am number 1 in India and number 1 in East and South Asia. I'm also number 1 in financials, which means financials across the world. As people submit financial ideas, I'm ranked number 1 in that. I'm also ranked number one in special situations, which is where there is specific trigger which will allow us to unlock the value. So I'm ranked number one. And across all categories, out of these 15,000 analysts worldwide, I'm ranked number two. And on the right-hand side, you will see the ranking that I have. I'm just going to make it a little bit bigger. So this is the rank that I had as of July 2025. And you can see some of the ideas which has enabled me to be ranked number one, right? So you will see that IDFC Limited, which I had presented before it became IDFC First Bank, did very well for us. And that was one of the reasons I'm ranked number one. Similarly, Ujjivan, again, Ujjivan Financial Services Limited was an idea that I had presented. It delivered a 359% return, as you would see here. So that helped with my ranking. And then the third one that has done well for us is IIFL Finance. And so IIFL Finance did a 333% total return. So these are total returns. And you can see that each of them have delivered more than a 4x for the period for when I presented the idea and when I closed the idea. So at this point, IDFC Limited and Ujjivan, these two ideas are closed, which means we started at a certain price and we closed when the price became 4.6 times or 364%, right? Similarly, for Ujjivan Financial Services Limited, I started at 100, let's say, and it became 460, and then we closed the idea. And IIFL Finance is still open, and it has done 100 has become 433. The most recent idea that I had presented was Repco Home Finance Limited, and that has delivered a 29% since presentation, which was around end of April. And there are many ideas. There are like almost 15, 16 ideas on this platform. The case studies that I mentioned would help us go through some of these ideas in a brief manner. And if time permits, we'll definitely do that. So that's sort of a little bit of the flavor of the research that I have done. Now, moving on, before starting my investment journey, as Professor Karmakar said, I was in the corporate world and I retired from S&P Global as a managing director. And prior to that, I worked on Wall Street with firms like Goldman Sachs. So there I was heading risk technology for them. And prior to that, I was at Bank of America, where I was heading market risk technology. And prior to that, I was at JP Morgan, where we were building out a risk system for the custody business of JP Morgan. As Professor Karmakar said, I'm a CFA charter holder with a BTech from IIT Bombay and MBA from IIM Calcutta. So that's a little bit about myself. Now let me talk a little bit about the fund. So the fund is a US domiciled hedge fund, and it is registered as a foreign portfolio investor into India. So the advantage of investing in the fund is that it benefits from India's growth, and we only invest in public equities. And we invest in public equities which are listed both on National Stock Exchange and BSE, Bombay Stock Exchange. But we also invest in companies that might be listed on US exchanges and which are primarily benefiting from the growth that we will have in India, right? So those are the universe of opportunities that we look at. The fund was started in April of 2021. And since the inception, the fund has a history of outperforming both Indian and US indices, and I will show you later. The fund has a long-term orientation, and it has an 18% turnover between 2021 to 2024. And what an 18% turnover means effectively is that we have effectively been holding the position for around 5.5 years. So though the fund has not been in existence for 5.5 years, but there is a standard industry metric, which is how much of buying and selling are you doing on an annual basis. And using that, you can figure out how long is our horizon. So when we say we have a long-term orientation, it is reflected through the turnover rate of the portfolio. So, of course, the whole idea of this fund is that it enables international investors to participate in India's growth story. And what is very interesting is the correlation of the monthly returns that we have in the fund vis-a-vis S&P 500, because S&P 500 is the international exchange, or the exchange which is the most likely investment opportunity for these investors. So if the correlation is low, as you would have heard from various classes that you have taken, then the benefit of diversification is higher. And to that extent, the benefit of investing in the fund is not only good returns, but also better diversification, because the correlation is lower, and that enables you to benefit from the diversification. So that's a little bit of the background. Now, what I want to do is spend some time ensuring that we are on the same page in terms of the definition when I'm talking about investing and what you are understanding about investing. So let's go through some basics first. So first is, let's define what is investing. Okay. Many times people think that investing is savings, right? But that is not the case. So let's be clear. Savings is money that you earn, but you don't spend. That is savings. A portion of that savings should be liquid. So it should be invested in things so that if there is an emergency, you are able to draw on it. How much should that be will depend on your own individual risk appetite. The rest of the money should be invested, and where it should be invested depends on your own needs as well as your own abilities. Now, Warren Buffett's philosophy is what we follow at the fund, and that is how I have learned about investing. And Warren Buffett has said that investing is often described as a process of laying out money now in the expectation of receiving more money in the future. So investing should be done not because it will go up, but because you expect that things will be worth more. Not because the price has gone up, but because the underlying value will go up over time. Right? That is the definition of investing. Now, why is investing important? Right? So it's okay, we understand the definition of investing, but why is investing important? And it is important because if you see the slightly green shaded area, that is the human capital, right? Right now, you are in the class. At this point, you don't make any money. In fact, you have a negative cash flow because you pay fees to IIM Lucknow to having the privilege of attending the classes, right? But your human capital is at its highest level. And what is human capital here? This is human capital is described as the net worth or the net present value of all the dollars that you will earn between now and when you retire. That is your human capital, right? It is right now, in terms of the cash flow, it doesn't help, but this is the point at which your human capital is the highest because all the cash flows are ahead of you. All the savings, all the money that you will earn are ahead of you. But at the same time, your financial capital, other than if you have been born rich, which some of you might have, but other than that, your financial capital is pretty much zero, right? So human capital is at its highest, but your financial capital is at its lowest. As you go through your life journey, your human capital will keep coming down, not because you will not earn a lot more money in the future, but because in this definition, we are saying human capital is all the money that you will earn through your life, right? So therefore, it assumes that you already know what you will earn. And so as you earn some money, the human capital will keep coming down. And your financial capital will keep going up. So while at this point you might think, listen, I don't have too much money, therefore, what is the importance of investing? You might be right, but it is the effect of compounding that allows your financial capital to keep growing over time. And the sooner you understand investing, the sooner you can start investing, that compounding effect will allow your financial capital to grow over time. And that is where investing is important, because the sooner you start, the more years you have to compound, and that will allow your financial capital to grow far bigger than if you start much later in your life. So that is why investing is important. What is interesting is that, and most of us go through this life cycle, where right now you're in college, and when you go into the workplace, you will be working for money, right? Which basically means that you're working. And if somebody asks you, why are you working? It is to have the lifestyle that you want, right? It is to learn. But if you can learn without getting paid, you will not, or if you are not getting paid, you will not be working, right? So you're working for money. And then over time, as your financial capital goes up, your money will be doing the working for you. And so this is another way of saying why is investing important is because over time, you don't have to chase the dollars. The dollars will automatically grow even when you are enjoying a nice siesta in the park. So I think that is important, and that is why investing is important. Now, what drives investment returns? Again, all this class understands the compound interest formula very well. And so compound interest is the future value is equal to present value times 1 plus r to the power of n, right? Where r is the rate of return and n is the duration of investment over which you are investing. And what most people focus on is the rate of return. And many people forget that it is a duration which will ultimately allow your investment to grow over time in a manner which will surprise most of us because this is not a linear equation, but it is a compound interest equation. And as Albert Einstein has said, that compound interest is the eighth wonder of the world. He who understands it earns it. He who does not pays it. And so it is really important to bring this power of compounding to your own financial journey by understanding it deeply and realizing how consequential N is in terms of what it can do for your financial situation. Here is a chart which I think elaborates what this compounding does, right? Both the power of R, which is the rate of return, and the years of compounding. So if you had invested $1,000 at your financial journey, right, what happens after various different time periods? And you will notice that the first 10 years pretty much just goes by without really too much happening to one's financial wealth. And whether you are doing a simple compound, simple interest, or a compound interest, the amount is not very distinguishable, right? Also, another important thing is whether you're compounding at a 7% or 10% or a 13%, the numbers don't really make much of a difference. But what does happen is as you keep lengthening the duration from 10 years to 20 years to 30 years, you can see how even a 7% compounding, which is the light green line, is higher than a 13% simple interest. So the power of compounding really becomes visible over the later years of one's life. And again, this is very important to understand that if you can compound, let your money compound over time, that is the biggest good thing that you can do for your own financial wealth. And this is one of the things why in 2016 I was able to retire from a corporate world because at that point I felt my financial journey has taken me to a position where I can just manage my own money and be very comfortable. And then I moved from, rather than chasing money, I moved from money compounding itself and I enjoying the fruits of that compounding, right? And I think this chart hopefully illustrates to you that the compound interest allows one to really differentiate vis-a-vis many other people who will not understand this and are not really looking for the long term. Okay, so moving on. How to optimize? So I talked about the rate of return and the duration over which you can earn the returns. So how do you optimize for this rate of return as well as the duration? And remember, both are important, but if you have to choose one, the duration becomes far more important because a longer duration, even at a lower rate of return, will give you much, much better returns in terms of the total wealth than if you do it for the shorter period. So to have a long duration, first is don't try to maximize the rate of return. That's very important in every time period. What happens is most people are chasing whatever is the latest fad. So if quick commerce today is the latest fad in India, everybody is running about after quick commerce. Or if defense is a new buzzword after the recent Pak India conflict, then everybody is chasing defense stock. The problem with that approach is not that you should not chase it, but you should chase it for the right reason. And the right reason, once again, going back, to Warren's definition is that the right reason is where you have a reasonable expectation that the value of what you're investing in is worth much more over time. Not because the price will go up, but the value of that business is worth much more. How do you know that the value of the business is going to be worth much more? That will only happen if you understand the business, if you know how the business will grow, and then you are able to continue to be invested in that business for the long term. So therefore, if you don't understand the business, or even if you understand the business but you cannot value it, it is not investment. And if it is not investment, then you will not be able to be invested in it for the long term. When the price goes down, and it inevitably does, no matter how good the markets are, then at that point, it becomes very difficult for most people to be able to continue to be holding those particular positions. And that is why your duration gets shortened. And that is why it is hard to do as well. Right? Which is the second point. Don't invest in things that you don't understand. And so these are the two don'ts. Let's look at what are the do's, right? To optimize the rate of return as well as the duration. So the first do is to find an investment approach that works for you. Now, an investment approach could be, listen, I just invest in mutual funds and I can do a SIP, right? Very, very popular in India, systematic investment plans. That could be one. It could be where you say, no, I understand a certain class of businesses, a certain industry. Like in my case, we understand financials and technology much better because that is my background and I feel I have some advantage there. So those are the areas that we do a lot of our idea generation in, but we are continuously looking for new ideas everywhere, right? So you need to find an investment approach that works for you. And if you are not willing to find that, you should then find a person or a firm or an investment vehicle whom you can trust. Very important in investing is the trust and the longevity, right? And so find a person whom you can trust and whose investment approach, the second aspect is equally important, whose investment approach you are comfortable with. Because what inevitably happens is that if you are uncomfortable, you will get shaken out of your investments at the wrong time when the markets have moved against you. And so it is critically important to ensure that you understand the approach and stress test yourself that if things go bad, how will I react? In addition, it is important to ensure that your incentives and the incentives of the person with whom you're investing, they are aligned. Because all of us are governed either consciously or subconsciously by our own incentives. So it is important to have your incentives aligned. The second thing is ensure that you don't focus too much on the short-term market moves, right? Many of you here possibly knew about what happened during COVID when the markets came down dramatically. And if people actually were shaken out at that point, I know quite a few of my friends who have continued to sit on the cash because they were concerned that the market will have another big leg down. And so you should not worry too much about the short-term market moves, but really focus more on what the business will do over the long term. And lastly, we talked about this emergency reserve. It is again very important to have emergency reserves so that you don't feel like, oh, I need more money when the market goes down and you don't pull out money from your investments. Rather, if you have the money, you should be deploying that into the markets, into the opportunities that you do understand. So these are some of the basics that I feel will allow one to be invested for the long term and yet also get good returns when you are investing. Okay, so with that basics around investing, what is savings, how do you ensure that you can think from a long-term perspective? I want to actually move on to our investment approach. But before I do that, because I think this is as good a point as any, are there any questions anybody has so far based on what we have talked about? since I cannot hear you unless you speak in the mic, if there are any questions, I would encourage you to just speak in the mic and ask the question. If not, I'll give it a minute or two to see if anybody has a question. If not, we will go on to the next section.
Yeah, do you have any question? Then I can come with this mic. So first you have to listen, no? No question? So Mr. Agrawal, I believe everyone has understood everything. I'm not having any question.
That's fantastic. Professor Karmaka, that's why you keep having me, right? Because I'm such a good explainer of things. No, I'm just kidding. Okay. Okay, that's fantastic. Okay, so then we will move on to the next section, which I'm sure some of you would have more interest in, which is how do we invest given what I talked about so far. So our investment approach. So the way we think about investing is governed by the following tenets that we follow at the fund. The first is whenever we are investing in any opportunity, we always look from an expected return framework. And what basically that says is it's a pretty simple concept. You are looking at what is the value of your stock today, what is the price of your stock today, what do you think it should be worth a few years out, and therefore what is the return that I will get if I were to invest in that particular opportunity, right? So this is expected return over the holding period on that stock. And when we look at the expected return, we don't know exactly in 3 years or 2 years or 5 years it will play out. But remember, investing is always about looking into the future. Future, by definition, is uncertain. So therefore, you can never be certain, but you still have to make the best guess based on your understanding of the situation, right? And because the universe is so wide, what you have to then do is to break it down quickly into what is interesting and what is not. And one of the ways we do that is through the expected return. So we say, given the price today, given our expectation of how the business will do in the future, what is our total return? And from the total return, you can derive your expected annual or CAGR, right? Compounded annual growth rate. The second thing which is critical for us when we're investing in Indian equities is management quality. One of the key things that we have learned over time as we have invested in Indian equities, is that if management is bad, you will not be able to make too much money over the long term, because the management will take the money for themselves and the shareholders will not get much. So if we find a bad management, no matter how cheap the stock is, we are not interested, because in a legal system being what it is, it takes a long time for anything to happen. And so we only want to partner with good partners as far as the company management is concerned. Third, we only want to invest in our circle of competence. What that basically means is, because we are using an expected return framework where we are trying to value a business, if we don't understand something, we cannot value it. If we cannot value it, we cannot derive the expected return, and therefore it is not something that is in our universe of opportunities. Having said that, you only understand, or at least for us, our experience is that we only understand a business when we have invested for some time, because we then see how the business is evolving, how the management is talking about that evolution. And therefore, it is important for us to keep widening the circle of competence, because the circle of competence is the businesses that you understand. But the more you are then able to understand a greater number of businesses, the more your opportunity set will grow. And hopefully that will allow you to find more opportunities and then figure out which ones are the best, right? So we are always trying to grow our circle of competence, but the edges are something where we need to ensure that we don't take big positions. Those are the places where we are trying to learn a new business and we're taking small positions, trying to get our comfort, get our conviction in those ideas, in those businesses. And as we understand those businesses better, we are happy to take a bigger position. The next one is long-term orientation. Now, in this whole investing world, what is interesting is if you look at the investment world from a US perspective, where it has a longer history, earlier the holding period in the 1940s, 50s used to be 5 years. And in the more recent times, it has come down to less than a year. And today, the biggest number of options that are traded on US exchanges are the 0 day expiry options. And what that is telling you is that the world is becoming even more short term focused. Everybody wants instant gratification. And because they want instant gratification, there is more opportunity in the long term. So when we are investing, we are thinking from a multiple year perspective. When I say multiple year, typically we are talking about 2 to 4 years. And then, but we are not talking about 10 years because frankly, the businesses change a lot and we cannot, from as an outsider, see 10 years out. In fact, we think most management in India cannot see 10 years out because the businesses are changing so much. Even very stable businesses like the fast moving consumer goods, earlier Nestle's and Hindustan Unilevers and so on, were seen as secular businesses that will grow as Indian economy grows. But we have seen in the more recent past that quick commerce, e-commerce is slowing down their growth because there's a lot of private labeling that is happening. And so it's very hard to see far out, but at least if you look a few years out, we are able to assess them and we are continuously reevaluating our thesis as new information becomes available. So while we are keeping a multiple year horizon, we are always updating our horizon based on the new information. And then it is equally important to understand what not to do. Most of us only focus on what to do. But I believe that there are many areas where what is accepted as a wisdom or the right way to approach is actually wrong. And so, for example, the whole idea that volatility is risk in our mind is not something that we agree with. Volatility in our mind is a source of opportunity and not a source of risk. And this is not something that is treated in the standard financial literature. And we think this is where we can be different and benefit from. And I will give you an example of that. So we are buying a stock at 100, right? And suddenly the markets go down because there is tariff on India, right? And market goes down 20%. Now the stock is now worth $80 or 80 rupees, whatever, right? You still think, and when you invested at 100, you thought it is worth 120 or 150, whatever, it doesn't really matter. So there from 100 to 150, it was like a 50% return, right? But now when it has come down because of volatility, it has come down to 80. Frankly, it has become a much better stock, assuming that 150 still holds. So if, for example, the business is focusing on domestic economy, maybe there is a slight growth rate dip, and therefore 150 becomes 140, but still 80 to 140 is still a far better return than 100 to 150, right? And so we think that when the prices fall, that is when everybody talks about volatility, by the way, we think there are more opportunities if you can think based on the long term and the expected return framework and all that. So we always, when we are talking to our investors, we want them to understand that volatility is not only not risk, it is a source of opportunity for us. Second thing, in literature, it is said diversification is the only free lunch. We disagree with that. So diversification for the sake of diversification does not make sense. You should diversify like how I was describing earlier. You should diversify. If somebody invests in S&P 500, they are US investors, their primary investment universe is S&P 500. And here is a fund which can give you similar or better returns, and it has lower correlation. That is where you should diversify. But diversifying only because it gives you lower correlation without accounting for the return makes no sense. In many cases, people are diversifying between bonds and equities because they think, oh, well, one will offset the other. And I wrote a quarterly letter for June for my investors where I showed that the 10-year treasury has delivered a negative return over the last 10 years. And everybody thought, and this is treasury is the safest asset class that investors consider. And yet, over the last 10 years, US treasuries have delivered negative returns. And so it is a highly, highly risky asset class when the interest rates on a US 10-year bond was so low, right? And yet people said, oh, it is the safest asset class. So price changes everything, right? And so understanding when diversification is beneficial and when it is hurtful is what makes investing so much more interesting. The third thing is that many people, when they're investing, they're very closely hugging the benchmarks. As I said, for us, the investors who come to us, their primary investment universe is S&P 500. So when we, and I will present our historical returns, you will see we compare ourselves to S&P 500 just because that is the investment universe of our investors. But we also compare ourselves to the Indian indices because that is the investment universe that we are investing in, but we never focus on what is there in the benchmarks, right? Whether it is the Indian benchmarks or the US benchmarks, because we think benchmarks is a way to assess what is an alternative option for an investor. But that doesn't mean that that is what our investment universe is. In fact, by definition, it should not be. And so we think benchmarks is a good way for us to say how much value we are adding, right? But we don't want to, and most people, when they look at the benchmarks, they are trying to have the same securities a little bit higher or a little bit lower. We think that is a game which will not allow you to do well. And lastly, in this whole investment world, everybody talks about, oh, how much is your AUM? As if AUM will determine how good your returns will be. And we know, in fact, that that is the opposite. Higher the AUM, lower the returns. Like people who are sitting at hundreds of billions of dollars of AUM, they don't give any significant return. And I recently was reading a letter from a famous hedge fund manager, and he said over 20 years, our investors have got 5.5 times return. So $100 have become $550. And I will leave you as an assignment to figure out what was that annual return. So there's a lot of this narrative fallacy where people give you a 5.5 times return to say, oh, how well we have done. But over a 20-year period, a 5.5x is nothing great. And you can figure out what those returns are. So AUM doesn't tell you whether the approach works or not. We are much more focused on returns. AUM, good, bad, doesn't really matter. We want to do and we want to follow these investment tenets and deliver good returns, not every year, but over the long term. Okay, so a little bit about our portfolio allocation approach. So we follow, in fact, if you look at, again, the financial literature, and this is because this is what has happened historically, this is a standard wisdom, and this is what we have seen time and again, which is the returns are distributed in a power law manner. What does power law mean? That a few stocks give you the maximum return, and most of them give you very average return, right? And so, therefore, you need to understand that you will have to concentrate in your best ideas. And then you can have a tail, and we do have a tail, because tail is for our ideas pipeline. But just because of the power law distribution, unless you focus on your best ideas, you will not get the good returns. So we understand the power law distribution and we use that. And how do we use that? Is by taking into account this opportunity cost concept. And the opportunity cost concept is simple, which is if I'm investing in company A, if I were not to invest in company A, what was the next best opportunity and what is the return I can get from the next best opportunity? So understanding your opportunity cost and then making the decision based on that opportunity cost is important when you're doing the portfolio allocation. And this is something that Charlie Munger talks about. So as you can figure out from this talk so far, I'm a big believer in both Warren Buffett and Charlie Munger's philosophy. And for those of you who are interested in this space, I would highly encourage all of you to read the Berkshire annual letters, because it has the best return on your time invested, because it will tell you a lot about how to invest and how to think. And both how to invest and how to think are the two main ways that you can distinguish yourself. Equally important in investment, not only is getting good returns, but to manage the risk. As I already said, that risk is not volatility. So what then is risk, right? So risk is much more defined in a not a numerical manner, but in the touch and feel. And so, for example, if we don't understand the business, it's very, very risky for us. Why? Because we cannot value it. And if we cannot value it, then we cannot invest in it, because if the stock price goes down, we don't know what to do. And so, understanding of a business, and it cannot be quantified, it has to be qualitative. But that understanding of the business is a very important factor in whether a position is risky or not for you. The second thing, which is again not emphasized enough when you're looking at risk, is what is your past track record of that particular opportunity that you're looking at. Remember, we as humans are creatures of habit. Whatever we do becomes more and more, we start doing more and more of that. And so, past track record is a very good way for us to understand how something will happen in the future. It's not a perfect predictor by no means, but as they say, that the past rhymes with the future. It does not predict the future. It may not predict, it may predict, but it definitely rhymes, right? History rhymes. And to that extent, past track record is another way of managing risk when you're investing in a company. The third thing is management incentives. We talked about management, and management is a critical factor. So ensuring that management incentives are aligned with that of the shareholders is very critical. The more aligned they are, the more likely they have to behave in a manner which will help the shareholders do well for themselves. Next one is capital structure. The more debt a company will have, the more shaky it is, especially when times turns tough, like it happened in COVID, or like it happened in the global financial crisis of 2008, or any crisis. And that is where, if you have strong capital structure, you are able to take advantage of the fragility that is in the system. And many of you would have heard the term anti-fragile, right? And being anti-fragile requires you to be overcapitalized so that when the risk actually does show up, you are able to take advantage of the risk rather than be hurt by it. And so the stronger your capital structure, the less risk. Again, not easy to define or quantify. One way is possibly your ratings, for example, right? But not everything is rated. So you need to understand. And by the way, rating agencies many times are not keeping up. So you need to do your own work and understand how risky is company's capital structure and how risky is the company as such from an investment perspective. And this, I think, compelling valuation is the best risk management tool out there. I already talked about a 100 rupee stock. If it goes down to 80, is it less risky or more risky? But if it goes down from 80 to 60 again, has it become more risky? Only if you think that the actual value of the company has fallen from 150, it has come down to 75. Yes, possibly it's still 50%. And it can happen, it can even fall to 25, in which case it's very risky. So your ability of assessing the business and figuring out what is the value of the business versus the price at which it is selling, I think is one of the best risk management tool out there. So if you can find a company which is selling at a good valuation, and then when I say good valuation means at a very cheap valuation to its value, or very cheap valuation in terms of the price is much cheaper than the value, then that is where the risk is minimum. And all these are our pillars that we look at when we are investing or making decision about what to bring into our portfolio. And lastly is position sizing. The more we have confidence in a particular company, the more it is cheaper, the more the capital structure is resilient, the more the incentives are aligned, the track record is good, and moreover, comfort with the business, the bigger the position size. The less each of these factors are, the lesser the position size, right? And position sizing is again something which is not a precise science. I think there are things like Kelly's formula and stuff like that, but those things again are a brute force. There are too many nuances in investing for one to bring down everything into a simple formula. So all of these really help us decide what our portfolio will be. And these are the pillars into how we build the portfolio at DoorDarshi India Fund. A little bit more about the portfolio strategy. So our strategy, as I said, is long-term investing in listed equities. We don't use derivatives too much. And even when we do use derivatives, we will use it for hedging purposes. So it is very infrequent, but we do use it. And when we do, it will be only to ensure that we can hedge the risk that is out there. In terms of the number of stocks that we will own in the portfolio, we can go anywhere between 10 to 75. Right now, we own around 35 stocks. In terms of market cap, we will go across the market cap spectrum, small, mid, and large. So we will be across the spectrum. Now, when we look at the max allocation per stock, now this is very different than what you will see most fund managers will do. So we have a much higher allocation that we can go to. So I have defined here that the soft limit for a stock is up to 20%. And the hard limit is up to 30%. What that means is that till 20% of the AUM into one particular position, we are happy to keep buying, right? But we will never have one particular stock in our portfolio become more than 30% of the overall AUM. Now, to some extent, if you are aware of this industry, these numbers should shock you, right? Why should they shock you? Because most people say, I don't want to go beyond 5%. And we are saying 30%. So that's 6 times. And the reason we are willing to do that is because we think that compelling opportunities are not that frequent, right? And second thing is we believe that when we find a compelling opportunity, we want to take advantage of it rather than come out of it. And the best analogy here is we believe in watering flowers and cutting weeds. So right now, we have nothing which is close to this. Everything, in fact, in our portfolio is less than 10% per stock, or one stock is not more than 10% of the portfolio right now. But we give ourselves this max allocation per stock, which is much higher. So we have the flexibility that if and when we find good opportunities, we are able to participate in those. I already talked about the risk management. The one thing that I did not talk about is the pre-mortem. And when we are looking at any opportunity, we also try to assess what will cause us to lose money. So we want to have, many of us will do post-mortem what went wrong. We are trying to do a pre-mortem before it has gone wrong. We are trying to think through all the reasons why something will not work, and then trying to see if it does not work, what are the reasons? And then looking at those reasons and saying, what are the likelihood and why do we think it is a high probability, low probability, no probability? And that helps bring all the risks out there on the table for us to make a decision of whether we should be focusing on that or not. So the goal of DoorDarshi India Fund is to deliver a 2x or more than a 2x in 5 years. And if we are able to do that, then we are able to outperform both S&P 500 and Indian indices in general, right? So S&P 500 has delivered a 10% CAGR over the very long term. And something similar has been delivered by Indian indices in dollar terms. So therefore, if we can do a 15% CAGR in dollar terms after fees and expenses, then I think we will be more than 50% better off than what S&P 500 and Indian indices have done. And by the way, if we can do that, then we will be outperforming most of the fund managers out there, because most fund managers, 80% of the fund managers, are not able to outperform S&P 500. And here we are talking about a 50% outperformance. So that's the portfolio strategy that we follow at the fund. Okay, so before I go now, so I talked a little bit about our investment approach. We'll take a quick break here, see if there are any questions in terms of what I talked about. And if there are any questions, happy to take that. Otherwise, we'll move on to the next section, which is the historical returns. I don't know if Professor Karmakar is in the room, but if not, if anybody has a question, either just raise your hand or just go to the mic and speak in it. I'll give it a minute because I cannot see the class very well. And of course, I can't hear you right now without you speaking in the mic.
Hello, am I audible?
Yes.
So you said ki you can invest up to 30% of your portfolio in a single stock. So do you hedge the position or take a just a bare position on in the stock?
Yeah, no, so that's a very good question, which is how often do we hedge? Typically, we're not hedging at the individual position level. I think there is this whole industry which has come up, which is, oh, if you hedge, then you're getting a delta neutral return. But the risk with hedging, first of all, the hedges are never perfect. Second of all, if you hedge everything with everything, what you should get is, assuming you have no cost, you will get a treasury risk-free rate of return, right? If it is a perfectly working market. And so I don't think that such hedges make sense, because you are doing the work and you're trying to figure out where the businesses are cheap. And if they are cheap, then you should not be thinking about hedging them, but rather actually benefiting from the cheapness. So we don't hedge at the individual name level. We might hedge, let's say if Indian equity is expensive, we might take names, we will buy names where we think they're cheap, and then hedge at the index level if the index looks expensive.
So I had a question. So in the mentioned assess the value of good management, how to determine if management correctly. Determining bad management seems easier than figuring out, which management necessarily good as an investor.
Yeah, so I think your voice got cut, but basically I got the gist of it. I will repeat it and you tell me if I got the gist of it, which is, how do you define good management? Bad management is a lot easier to define than good management. Is that correct?
Yeah.
Okay. So I think that's a very fair point, which is that, once you have removed the bad management, the rest of them are good, right? So the goal here is to first remove the bad apples, because then you want to minimize. Remember always that the universe of investment opportunity that we have is fairly large, right? Let's say there are 4,000 plus listed stocks in on Indian equities. And let's say for us, the investment universe is the top 1,500 stocks. Okay. What we are saying is we typically are investing up to 75 stocks. Right now, we have 35 stocks, and we are not completely overturning the portfolio. So in a year, we might add 5 to 10 positions and sell something, right? So all we are looking for are 10 positions in a year, once a month, right? And so really, if we find something which we think is a little bit dicey, we can move on to the next one. And there is no reason for us to keep spending time on areas which looks unclear, doubtful, and worse. We can move on to the next one. And I think that is what we do. So maybe it can be reworded as remove bad management, or don't worry about bad management, rather than look at good management. Any other questions? Okay. Okay, so then I will move on. And those are all good questions. And if there are questions, what we will do is we'll go through this section. We will again take your questions after that, and then we will have a break, right? Because I think we have been at it almost, 50 minutes, 55 minutes now? Okay. So let's look at historical returns. So these are the returns of the fund since its inception till end of 2024. So I will highlight a few things. So since our inception until the end of 2024, we have delivered in dollar terms. So everything is dollars, okay? Because our investors invest in dollars. And even Indian indices that we have put are in dollars. So we have converted the returns, which are rupee returns, into dollars. So since inception till the end of 2024, why 2024? Because those are the audited returns. Our auditor has audited these. And so our returns have been 25.8% CAGR. S&P 500 in that same period has delivered 12.7% return. Nifty 50 in the same period has delivered 10.2% return. And MSCI India has delivered a 11.1% return. So the first thing to notice is that we have delivered far better than both S&P 500 from a US perspective, but also the Indian indices as reflected by Nifty 50 or MSCI India. Now, this is where the compounding comes in, right? This 25.8% annual return translates into a total return of 137%, which means that $100 invested in the fund has become $237 in that less than 4 years, versus it has become $157. $100 invested in the fund became $237. In S&P 500, it remained 157. In Nifty 50, it's 144. And MSCI India, it's 149. So far, far better, because the 25.8% return has compounded over 3.75 years. The third thing then to notice is that if you look at the fund returns over these 4 years vis-a-vis S&P 500, and why are we taking S&P 500? Because that is the next best return profile here, right, that I have put. What you will notice is that 3 out of those 4 years, S&P 500 delivered more than a 20% return, right? 2024, 2023, and 2021. On the other hand, 3 out of the 4 years, the fund has delivered a single-digit return, right? 8.9%, 9.3%, 9.8%. But the main difference is that in 2023, we delivered a 81.2% dollar returns, right? And S&P 500 delivered a minus 18.1% return. And so when I present this slide or this table, people say, oh, what happened in 2023? What caused a 81.2% dollar return? And the answer is, well, we have been investing in the same stock or similar stock in 2021, 2022, but we got really paid for that in 2023. Because remember, market does not move in a linear manner. Market has episodic runs and episodic falls. And so being well positioned and being patient is what gave us the opportunity to do well in 2023. And equally important is that when we are investing, we are always investing so that we don't lose money. Some of you will know Warren Buffett's rules of investing. The first rule is don't lose money. The second rule is don't forget rule number 1, right? So the losing money is one of the biggest things that one can do to do well in investing. And what at least so far we have delivered in our fund is not having losses and delivering very strong returns episodically. And we think that is the only way we can succeed. We cannot promise any return in any year. But if we keep following the investment approach that I laid out, we think that we can, over time, not every year, but over time, we will do better than the markets. And so far, at least, we have a track record to prove that. Now, a few caveats, obviously, on the returns that I have laid out here. The first one, past performance does not guarantee future results. So we are not saying that because we have delivered a 25.8% CAGR in the last 3.75 years, that is what we will deliver in the future. We have no idea. All we will do is we know what approach works for us, and we are going to follow that approach. The second thing is everything that I'm presenting here is audited by our auditors, which is Spicer Jeffries. Third thing, the fund return reflects returns of all the limited partners in the fund. And these returns are after fees, after expenses, and after Indian taxes. So actually, we have our hand tied behind our back when we are presenting these returns, because these are not, remember, gross returns. These are the returns that our limited partners have got. The gross returns are higher than this because, remember, these returns account for, when I run a fund, there are many fees, there are many expenses that I pay to third parties. When I run this fund, I get fees for running this fund. And we also are paying Indian taxes. And then, of course, all the indices, as I mentioned, S&P 500, Nifty 50, and MSCI India reflect the returns in dollars, right? And these are total returns, so where the dividends have been reinvested. But that is the case for the fund as well. So it is a like-for-like comparison. So if I reflect the same returns, what I showed you in a tabular form, in a graphical form, you can see how the $100 invested in the fund has moved. As I said, it has become $230, $37. While in the three indices, it is between 140 to 160. And you can see the gap that we have opened up with these indices in the last few years. Now, I said the returns are 25.8% or 137% total return for the returns after paying taxes in India. What does happen for our investors is that most of our investors invest through their taxable account. And when you invest through your taxable account, you actually get an offset for the taxes that the fund has paid on the investor's behalf in India. And so the economic returns are the fund returns before taxes. And if I look at that, and that is the right way to look at it, because if you are getting benefit of the taxes, then you should add those taxes back and look at the fund returns before taxes, before Indian taxes, right? And those returns are 27.9% annualized return or 152% total return. So even the outperformance that I showed you earlier becomes even better when you add back the taxes that we talked about. So I think it's fair to say that the approach that I talked about in the previous section works very well for us. And that is reflected in these historical returns that I'm laying out here. So when we talk about these historical returns, the first question that I'm asked is, okay, fine, we understand you have done well. What is it that allows you to do well, right? Why is it that you do well when 80% of the fund managers or even more cannot even outperform S&P 500, and you are telling me that you have outperformed by more than 12% or even 13%, right, annually, when a 0% outperformance cannot be done. So what is it that you are doing? And I think this is where the investment approach that I laid out earlier has worked so well for us, right? We think that investment approach works. We think that investment approach requires discipline and having the patience. And so having the right investors is very critical. But let me go through some of the factors. When that question comes, I have a set of reasons which very frankly follow from our investment approach that I laid out here, but I will make it more explicit in this section. So first of all, I always emphasize that when people ask me, why do you succeed? I always like to tell them we succeed, first of all, over the long term. And long term for us, we tell is you should not judge us every year. If you judge us every year, I think you will be disappointed. And I will be disappointed because frankly, nobody knows what will happen in a year. So it is important when you're looking at the performance of the fund to at least look over 3 years, ideally 5 years. That is what the performance should be judged. Now, when we are making investment, we think it is very, very important to focus on what are the important things. What are the important things then? First is investment philosophy, right? And as I said, our investment philosophy is the expected return. Too many people in this industry focus on what the company will do, but they don't focus enough on what is the price you are paying for it. And frankly, if a company will do well, the price already of that particular stock is already reflecting the good performance of the company into the future. And so from our expected return framework approach, the expected return is not that compelling. And so having that discipline of saying, listen, yes, the business is good, but so are the prices. And so your returns are not that great, frankly, is a core to our philosophy of how we invest, which is we want good returns and we want to have good management and we want to have high uncertainty around it. That is where our investment process comes in. Once you define your investment philosophy, then you look at your investment process and say, how is your investment process allowing you to do well over time? And this is where not only defining how you will go about searching for opportunities, you want to keep searching very broadly, but at the same time, you want to quickly reject the idea and move on to the idea which could be the next best idea for you in terms of the opportunity set. And all of that really requires a lot of discipline and a lot of patience. Because as many of you, if you track the stock market, Indian stock market, I think it is not a cheap stock market. It is pretty expensive, in fact. The small cap and mid cap are at very high levels, and even Nifty 50, the large cap even, is trading at a high level. So it is not a cheap market. And when it is not a cheap market, it is important for you to have the discipline and the patience so that you are not investing in companies which will not necessarily give you compelling ideas, even though in the short term they may perform well. So all of these different layers of the onion, investment philosophy at the top, investment process, discipline, helps us then build our portfolio. And that is a portfolio that ultimately performs over the long term. So we focus on what matters, which is the portfolio. And how we get to that portfolio are the different layers of the onion that I talk about here. Equally important, and I keep saying it, there are always two sides of the coin. One, focus on what is important, but equally important, ignore what doesn't matter, right? So what doesn't matter is looking good. Too many people in this industry are trying to look good. How are they trying to look good? By coming up with an artificial construct called a Sharpe ratio. Why is Sharpe ratio, in my mind, a highly flawed measure of risk or of investment prowess? Because at its denominator is the standard deviation, or nothing but the volatility. And as I have said, volatility is not risk. So you put volatility in the denominator, the whole industry is focusing on reducing volatility, reducing the standard deviation. We think that's the wrong measure in the first place. So we are not focusing on Sharpe ratio at all. We are focusing on, can we deliver good returns over time? And can we try to avoid losing money? To us, losing money is the biggest risk in investment, right? I'm not saying we'll not lose money. We will have a down year. There is no question about it. But can we, over many years, have enough up years that the down year, even after down year, we will do good returns over the very long term is what we are trying to achieve. So we are not focusing on volatility. We are not focusing on AUM. And when I say I'm not focusing on AUM, what we are trying to say is, if an investor does not align with the approach that we have, we don't want them in the fund. We don't want them in the fund because if a wrong investor comes into the fund, what they will do is they will unnecessarily create impatience in the fund positions. And that will unfortunately not hurt themselves, but hurt all other investors. And that, I think, is a big risk. So we don't want to focus on AUM. We definitely don't want to focus on the wrong investors. We also don't want to focus on the fads, right? As I said, quick commerce is a big fad. Defense stocks is a big fad. You look at defense stocks, what prices they're trading for, what are the business prospects, and then look at, does it make sense? Maybe after 5 years it will start making sense, but we cannot look so far out. It's very hard for us to have a strong view 5 years hence what will happen in some of these defense companies, right? And so it becomes critical for us to focus on what we can understand and not become too sure about things which are very uncertain. And what it really requires is a very open mind, a mind which is willing to change itself continuously as new information becomes available. Today, I'm sitting here and saying, well, we don't like defense stocks. If my understanding tomorrow changes and I say, no, defense stocks will do well for the next 10 years, and I was wrong on saying, no, I cannot look beyond 5 years, then I should change. Alternatively, maybe the market is saying 20% growth in defense stocks. Maybe they grow at 40%, and then the valuation not only makes sense, they become compelling. So the one key requirement in investing, which I'm not mentioned here, is a very open mind to change your mind when the facts change. And then also the diversification thing that I mentioned, which is remember that there's a power law distribution and good returns come only from a few positions. And it is important for us to ensure that when we find a compelling opportunity, we take full advantage of it. The other reason why we succeed, we don't make decisions by committee. So there's only one person who makes the decision around buying a stock or not, and that is myself. And so because of that, if something goes wrong, you don't have to look anywhere. You are just looking at the person right in front of you and you say, okay, Rajeev, you made a mistake. And I will say, yes, I made a mistake. There's nobody else to blame. So I think having that clarity of responsibility makes it so much easier for everybody involved, because there's no pointing fingers. If there's one finger that should point, it should be at you, because you made the decision. And so if you do well, you get bouquets. And if you don't do well, you get the brickbats, right? So the clarity of responsibility is critical. And therefore, I know what I am dealing with, and I don't have to answer to anybody about why I'm right or wrong, because my results, and that is the beauty of this whole investment world, that my results ultimately prove me right or wrong, not in the short term, but over the long term. And then the second reason we succeed is because I am having massive alignment of incentives. Remember, when I was talking about management, I was telling we should have alignment of incentives with the management. Similarly, when investors are investing in the fund, they should have alignment of incentives with the fund manager. I am the fund manager. And by having that alignment of incentives, so that if the fund does well, I do well. And I'm the biggest investor in the fund. So I have perfect alignment with my investors in the fund. Because if the fund does well, I do well. And that is the goal that every fund manager should have, that they should really ensure that if the fund does well, they, as an investor in the fund, will do well. And that is what we have. Just continuing with the same thing, why do we succeed? I think having the right investors, and this is not emphasized enough in most presentations, is critical. Because remember, investors are the people who will either pull money out or pull money in at different times. And the biggest risk in this industry is that when you don't perform as well, what are your investors doing? If your investors are pulling money out when the fund is not doing as well, that might very well be the time when you have the best opportunities to invest in. And if they pull money out, you are anyway shaky. First, your positions have gone down, whether because the market has gone down or your specific companies have not done well. And now, assuming that the companies have good prospects from there, if the money is getting pulled, you cannot really invest in those. You have to actually start selling. So having investors who can think long term is important. And we always check for that. The way we check for that is say, listen, if you're looking to come in the fund for the next year, don't. You should be coming into the fund for at least 3 to 5 years, because we want you to have that long-term orientation. That is important. And we also put things like, listen, volatility is not risk right in their face. We tell them volatility is opportunity. We think that when and if we find a compelling opportunity, we'll go up to 20% or in the maximum 30%. Right there, so that they know that if an opportunity comes, which is really compelling, we are happy to concentrate in a very meaningful manner. So it tells them that we are different and they should be comfortable with that approach. So having the right investors is critical. Similarly, having the right price of the stock that you're buying is critical, because the right price gives you a high return expectations. Again, going back to the expected return framework that I laid out there. And as I said, it reduces the risk, right? So a right price is a higher return, lower risk, which should not happen given the capital asset pricing model. But we think that is what happens in the market all the time, because the markets are not perfectly efficient. Markets are inefficient from time to time. And to that extent, if we can benefit from that inefficiency, then we have a chance at delivering good returns for our investors. And then lastly, we have very strong track record. I've shown you the track record of my fund since inception. But even before I started the fund, I remember I mentioned that I came out of the corporate world in 2016. And I came out of the corporate world in 2016 because since 2014, I have been tracking my performance myself. And before I started the fund in 2021, I got my personal returns audited from 2014 to 2020, and they were very good. And so that gave me the comfort to say, listen, I'm happy to take other investors now. So that right track record gives me the confidence to know this approach works, because this approach has worked for more than 10 years in a audited manner, right? And that gives us the confidence not only about the approach, but being selective with the type of investors we want in the fund, because we don't want any and every investor. And again, I've always said people make that mistake of just taking any money without realizing whether the money is a good fit for them, for their approach. And we think these three, investors, price, and track record, makes a very big difference in terms of how the fund does. And remember, as I said, the markets are inefficient from time to time. So here is an example or a cartoon of how the market inefficiency plays out. So this cartoon says just a normal day at the nation's most important financial institution. And we have a broker here who's saying, I've got a stock that could really excel and really excel through the mode of telephone or overhearing becomes sell, right? And here we have a crowd which goes mad on the right hand side selling a stock because everybody else is selling, right? And that is the reflexive loop that George Soros talked about. And after the selling has gone on for a long time, there's somebody who says in the lower left, it says, this is madness. I can't take it anymore. Goodbye. And goodbye, once again, through overhearing becomes buy. And once again, the crowd goes mad talking about the stock and buying the stock. And then the whole cycle repeats itself. But this is a funny way of just reminding ourselves when the stock price is falling that there is a lot of herd behavior that happens in the stock market. Things go up because everybody is buying, things go up or go down because everybody is selling. Why are they buying? Why are they selling? Is many times people are trying to be ahead of other people. They have not necessarily done the work, they don't understand the business as well. And so you don't have to follow the herd. Right? You can say, well, this is interesting that the stock price is falling. Let me do and check my work. Let me go and check my work. If you check your work and you feel comfortable that your work is good and the stock, even if it has fallen a lot, continues to provide good value, and you have the wherewithal, you should be able to buy more. And I think those are the type of things which will help one do well in the stock market. So I think I will stop here once again and see if there are any questions about our returns or about what I talked about in terms of why we succeed. I will give it a few minutes, see if there is a mic around and if anybody has questions to ask.
So how do you compare other portfolios with yours?
Yeah, so I mean, I think first we don't compare other portfolios with others, right? Because we don't necessarily understand other portfolios. So I think the first thing to remember in investing is you should invest in portfolios that you understand, right? Other portfolios people will do based on what their understanding is. What they understand and what you understand may be very, very different. And so when you start comparing either their portfolios to yours or their returns to yours, you have no idea how they made the decision, why they made the decision. So therefore, we try not to worry too much about what others have performed in the short term, right? We try not to worry about what they own. In fact, sometimes we will look at what people own, and we will do that for generating ideas, right? But generating ideas is different from owning those ideas because once you have generated the ideas, those ideas should become yours over time. How do they become yours? If you understand them well. So if you don't understand them well, they're not your ideas, they're borrowed ideas. And if they're borrowed ideas, you will not have the confidence. And if you don't have the confidence, then Mr. Market, stock market, will take you out of those ideas. So my suggestion is you can look at other people's portfolios for getting ideas, but don't invest in them till you have understood them and you have become comfortable that you know why you're investing in them.
So, sir, how do you compare your portfolio with the market portfolio? Only returns or are there any other metrics?
I think ultimately returns over time is the best metric because when I say compared with other returns, as I said, I think we compare our returns to the benchmarks, which I showed you. What we also tell our investors is they can use whatever other benchmarks they want to use, because remember, for an investor, which is where these type of comparisons become useful, they can decide what are their alternative opportunity sets, and they can compare the returns to whatever returns they have opportunities in to invest in. Right? It could be real estate, it could be whatever. I don't really care. That's for them to decide. But from my perspective, these are the comparison benchmarks that I use.
Okay. So last question, sir. So for selecting any stock, so you don't look for the volatility of the stock that brings to the portfolio, right?
So volatility is important only to the extent that it makes the stock even more compelling for us. Right. So if the stock price moves up and down a lot, I think, suppose we think that a stock is a good buy at 100, right? But we see that the volatility in the stock is so much. Ultimately, what is volatility? Volatility is either the demand for the stock or the supply of the stock at different times, right? That is what causes the price to either move up or move down. So if we think that there is a lot of movement up or down, we, instead of, suppose we think 100 is a good buy, we might even wait for a 95 and then buy, or a 90 and buy, right? So volatility is our friend. And where there is high volatility, we might be even more patient in letting the stock become even more compelling for us before we start buying.
Good evening, sir. Thank you for the session. So I had more of a general question about the Indian equities market currently. So if we look at the Indian IT industry right now, one might argue that they are currently somewhat undervalued. And like if you look at like most of the companies quarterly results this time around, they are more of, revenues are stabilizing. They are sort of like undervalued. They're not growing that much, which might be because of, not any specific major growth prospects in the Indian IT industry, specifically due to the emergence of AI. So one might argue that, US tech stocks would be more liable to, more susceptible to, grow at a faster pace compared to the Indian IT industry. So what do you think? What are your expectations specifically from the Indian IT industry, since your fund also invests in the Indian equity? So what do you think about their growth prospects in the short to medium term?
Right. No, so I think Indian IT industry is much more sort of project led, right? And what is happening, and again, these are my views. Of course, I can change at any time. But as of now, I believe that the whole artificial intelligence revolution that we are going through is increasing the productivity of the employees dramatically. And therefore, if the model is based on a person, how much money you will be paying per hour, then what will happen is the number of people required per project will go down. And it will go down because artificial intelligence is making all of us more productive. And therefore, you don't need as many people to do the same amount of work. Or for a bigger amount of work, you need the same number of people. And so the traditional growth rate that we have seen in the IT services industry in India may be in for a little bit of compression for a few quarters to a few years. We don't know that perfectly because we don't know how quickly the AI improved productivity will reflect in additional work. And so, in fact, I have mentioned that recently in my ET Now interview as well, that I believe that at least in the next few quarters, it is something to watch and see whether the growth starts picking. As you might have noticed yourself, the growth has been quite muted in the last few quarters. And if that continues, then the current valuations are definitely not cheap.
Mr. Agrawal,
Yeah.
so can we go on break for 10 minutes?
Sure.
And one thing that you have to set a tougher question this time, because this year I have found students are better than last year. So whatever you have taught and you will be teaching for the next session. So please try to set one tougher question.
Okay. All right. So we'll take a break. We'll come back in 10 minutes, Professor Karmakar.
Next means after 10 minutes, we'll come back. Sure. 15 minutes. Okay, 15 minutes.
15.
Mr. Agrawal.
Yeah.
Yeah, 15.
That sounds good. Yeah.
Okay, okay.